Hello. And welcome to Protrain's Certified Cost Professional CCP Preparation course. In this lecture we will talk about time value of money, interest rates, and cash flow. Let us get started. The time value of money is the central concept in finance theory. Probably you would have heard the old man saying, "$1 today is worth more than $1 tomorrow." The reason is straightforward. $1 that we receive today can be invested. And this investment shall fetch more than $1 at some future time. In other words, the numeric value of money increases as it travels in future. Let us take a small example to understand how time value of money works. This is John. John has received a lottery of $1 million. Wow! Isn't it? Lottery company gives John two choices. First is to get all money today. Another option is to get all money after a year. Nobody is going to wait for a year for his money. Needless to say, John shall choose to get money today. But let us understand why choosing first option is beneficial to him. And how much benefit John shall get by choosing this option. John chooses option 1. He receives all the money today. So what is he going to do with this money? Well, the least risky thing is to deposit it in a bank. Say, John does the same and he deposits the money in the bank. The bank offers him 5% interest rate per year. And the year passes. After 1 year John goes to bank and bank returns him the principal amount and interest. So what John gets after a year? Well, he gets this original amount of $1 million. And, in addition to it, he receives $50,000 as interest earned. It need no explanation that John has earned $50,000 more by choosing option 1 over the option 2. This is the underlying concept of time value of money. Note that the money increase with time is dependent on 3 factors. First is the rate of interest. Second is the amount of time the money is invested. And the third is the amount of money being invested. There is an important aspect of learning time value of money concepts for cost engineers and project controls professional. Engineering decisions frequently involve evaluating trade-offs among costs and benefits that occur at different times. A typical situation is when we invest in a project today in order to obtain benefits from the project in the future. We will discuss time value of money and other related concepts in details in this lecture. The purpose of this lecture is to introduce you to the concepts, terminology, and mathematics of the time value of money. After completing this lecture, you should be able to understand what is interest rate, and their types. Understand the relationship between present and future value. Describe how the interest rate can be used to adjust the value of cash flows, both forward and backward, and to a single point in time. use interest tables and understand how they provide a shortcut to calculating present and future values. Interest. Interest is the manifestation of the time value of money, and this essentially represents rent paid for use of the money. There are always two perspectives to an amount of interest: interest paid, and interest earned. Interest is paid when a person or organization borrows money, in other words obtains a loan, and repays a larger amount. Interest is earned when a person or organization saves, invests, or lends money and obtains a return of a larger amount. The computations and numerical values are essentially the same for both perspectives, but they are interpreted differently. Interest paid, or earned, is determined by using the relation interest equals end amount minus original amount. It is also represented as interest equals future value minus present value. Simple interest. Simple interest is calculated using the principal only, ignoring any interest accrued in preceding interest periods. The total simple interest over several periods is computed as interest equals principal, multiplied by number of periods, multiplied by interest rate. Compound interest. For compound interest, the interest accrued for each interest period is calculated on the principal plus the total amount of interest accumulated in all previous periods. Compound interest reflects the effect of the time value of money on the interest also. The interest for one period is calculated as interest equals principal plus all accrued interest, multiplied by interest rate. Let us take a small problem to compare simple and compound interest with each other. Say we have a simple problem where the principal amount is $100, rate of interest is 10% per annum, and the period of lending, or borrowing, is 3 years. A bar now shown on the slide presents timeline. This will help us to understand how simple and compound interest works. Now, at first let us work on simple interest. At year 0, or at the beginning of year 1, we have $100 as principal amount. Now let's go to the end of year 1. Here we will have principal of $100 and we will also earn interest of $10. Simple to understand, no complex mathematics, 10% of $100 shall be $10. Now let's go to year 2. Here we shall find, the principal amount for year 2 shall be $110. How? Simple again. Principal amount for any period shall be sum of interest plus principal for the previous period. Now let's go to interest part. As we learned in the definition on the earlier slide, in the simple interest, the interest amount shall be calculated on the original principal. Therefore, we shall use the original principal of $100 to calculate interest amount for year 2. Similarly for year 3, principal shall be $120 and interest shall be $10. With this the end amount shall be $130. Now let's go to the scenario of compound interest. For year 0 r at the beginning of year 1, things are same, principal amount is $100. Again, on year 1, similar to simple interest, principal shall be $100 and interest shall be $10. Now let's go to year 2. On year 2 there is no change in the principal amount. This is $110, which is sum of 100 plus $10. However, there is change in the interest amount. Now let's see how the interest we have calculated here. As we know that, in compound interest, interest is calculated on principal as well as the interest accumulated till the period. Therefore here we shall earn interest on the $110. So 10% of $110 is $11. Similarly for year 3, principal will be $121 and interest amount shall be $12.1. And the end amount shall be principal amount, plus interest. This shall be equal to $133.10. Now, if we compare the end amount calculated using simple interest and compound interest, we shall find that the end amount calculated using compound interest is higher than that of simple interest. Reason is simple, and we know, this is because in the compound interest, we also consider till period cumulated interest, when calculating interest for the period. Here we'll talk about nominal interest rates. Nominal interest rate is the annual interest rate disregarding the effects of compounding periods that are more frequent than annually. Nominal interest rate is denoted by R, and number of compounding periods are denoted by K. Let us understand nominal interest rate by an example. If banks tell you the interest rate is 10%, nominal rate, and the interest is compounded quarterly, 4 quarters in a year, therefore K equals 4. This means that you shall gain interest at the rate 2.5% per quarter. Common practice is to express interest rates at the nominal rate even though there is compounding such as quarterly, monthly, daily, or even continuous. The nominal rate is not the same as the annual rate except in the case of annual compounding. Ratio of nominal interest rate to compounded period, R divided by K, is referred as effective interest rate for the compounding period. This is denoted by theta. Let us understand why this term came into existence. When computers were not so prevalent in the banking industry, bank used to tell the interest rate on nominal basis. The basic idea was to express how interest shall be calculated in simple manner. While banking industry is fully computerized, however, nominal interest rates are still used in day-to-day terminologies. Let's talk about effective interest rate. The effective interest rate is the interest rate restated from the nominal interest rate as an interest rate with annual compounding. It is denoted by I. It is also called effective annual interest rate, annual equivalent rate, or simply effective rate. If the nominal interest rate and compounding period are given, or effective interest rate per period is given, it can be converted easily to the effective annual interest rate by using equations below. The formulas are I equal to 1 plus R divided by K to the power K, minus 1. And when effective interest rate per period is given, the formula I equal to 1 plus theta to the power k minus 1 can be used. Here we shall compare nominal and effective interest using a simple example. RBN Maro Bank charges 24% annual interest on the credit card balance. The interest is compounded monthly. Explain terms nominal interest rate, effective interest rate per period, and effective interest rate per annum, using this example. Let us start solving the problem. Here compounding period are more frequent than annually. Therefore, the rate of interest of 24% is a nominal interest rate. Let us calculate effective interest rate per period. Here nominal interest rate, R, equals 24% or 0.24. As the interest is compounding monthly, therefore, compounding period shall be 12. Or, K is equal to 12. So, effective interest rate per period, or theta is equal to 24% divided by 12. This is equal to 2% or 0.02 per month. Now let us calculate effective interest per annum. The formula is I equal to 1 plus theta to the power k minus 1. When we put value in formula, effective interest per annum, I equals 1 plus 0.02 to the power 12 minus 1. This is equal to 0.2682. Or 26.82%. Continuous compounding. In previous slides we discussed about nominal and effective interest rates. We learned term K, this was the number of compounding per period. Essentially, we are talking about some finite number of compounding in the year. This is called discrete compounding. In other words, discrete compounding occurs when interest payments are made at the end of finite compounding periods. Now let's talk about continuous compounding. As the duration of the interest period becomes infinitely short, the number of compounding periods per year becomes infinite and is referred to as continuous compounding. If we take the formula of effective interest rate discussed in earlier slide, and limit the value of k to infinity, the formula for continuous compounding shall be rate of interest for continuous compounding, or I, is equal to e to the power r minus 1, where e equals 2.718. E is nothing but natural log base, and r is nominal interest rate. Let us take a small example to understand continuous compounding. Nominal interest rate is 24%. What shall be the effective interest rate when compounding is continuous? The formula is I is equal to e to the power r minus 1. Let us put value in the formula. I equals e to the power 0.24 minus 1, which is equal to 0.2712 or 27.12%. In the previous slides we were talking about different type of rate of interest. Here on, we shall talk about terms relating to various financial values. If you're not already conversant with these terms you may find them a bit difficult. However, as we shall go along with this lecture, we shall gain more clarity about these terms, and how to use them in economic analysis. Now let's start our discussion on economic analysis with present value, or P. Present value is as on date or to date value of a given payment or series of payments made at other times in future. In other words, any value that occurs at the beginning of the problem, or the beginning of a part of the problem, is a present value. This is denoted as P. This is the current worth of a future sum of money, or stream of cash flows given a specified rate of return. The present value occurs before any other cash flows. Usually, when a present value is given, it will be surrounded by words indicating that an investment happens today. On cash flow diagram or line, the present value occurs at time equal to 0. Also, P is referred to as present worth, PW, present value, PV, net present value, NPV, discounted cash flow, DCF, and capitalized cost, CC. Let us take an example to understand present value. Say, you deposited $100 in your saving account in a bank. The interest rate is 10% per annum. With this at the end of the year you shall get $110 from the bank. In this example, amount of $100 is present value of your investment, and $110 is future value. We shall talk about future value in next slide. Future value is the value at specific date in future. This is the value of an asset, or cash at a specified date in the future, which is equivalent to a specified sum today when calculated based on time value of money. The future value is a single cash flow. It is usually the last cash flow. If it occurs more than once, then it is probably an annuity payment. This is also called future worth, FW. Next term is annual worth. This is denoted by A. Annual worth is series of consecutive, equal, end-of-period amounts of money. This is also called annuity, especially when payment periods are not annual. Annual worth is also called equivalent uniform annual worth, EUAW. A occurs with the same value each interest period for a specified number of periods. Unit is dollars per year, dollars per month or dollars per day. Let us take a small example to understand annual worth. Say, you took a loan of $5,000 from a bank. Bank requires you to pay back by paying $1,000 per year for next 6 years. In this example $1,000 is equivalent uniform annual worth of present value of $5,000. We shall understand this more clearly when we shall discuss discount factor at later part of the lecture. N is number of interest, or compounding periods. It can be in years, months, days. T is time, stated in periods, years, months, days. We must understand here that N and T are different when it comes to time value of money calculations. The time value of money concept is based on compounding period N, so are the formulas. We have already discussed nominal interest rate and effective interest. Here, we must understand that the interest accrued is dependent upon number of compounding periods, N, not on the time T. I is interest rate or rate of return per time period. It can be in percent per year, percent per month or percent per day. B is benefits or income. The unit of this term is dollar. C is cost or expenses. The unit of this term is dollar. EOY stands for end of year, usually followed by a number, indicating which year. In other words, EOY4 indicates end of year 4. G is uniform or arithmetic gradient amount, a constant increase in funds flow at the end of each period. K is number of compounding periods per year. MARR is minimum attractive rate of return. SN is expected salvage value at end of year. With this we complete our discussion on terminologies of time value of money. All engineering economics problems involve the element of compounding period, N, and interest rate, I. In general, every problem will involve at least 4 of the symbols P, F, A, N, and I, with at least 3 of them estimated or known. What is cash flow? As name suggests, cash flow is nothing but flow of money. When we say flow of money, this can be for any business, commercial establishment, non-profit, or an individual. In other words, cash flows are inflows and outflows of money. Cash flow can be further divided into 2 types. First, cash inflow, where money comes in, and cash outflow where money goes out. We will discuss this in more detail in next slides. Before that, let us quickly learn some important points on cash flow. Cash flows may be estimates or observed values. Of all the elements of an engineering economy study, cash flow estimation is likely the most difficult and inexact. Cash flow estimates are just estimates about an uncertain future. Cash flows occur during specified periods of time, such as 1 month or 1 year. Usually point estimates are made, that is, a single value estimate is developed for each economic element. If a statistical approach to the engineering economy study is undertaken, a range estimate or distribution estimate may be developed. As far as this course and CCP certification is concerned, our discussions shall be limited to point estimates. Cash inflows, or receipts, may comprise of the following, depending upon the nature of the proposed activity, and the type of business involved. In the simplest term, cash inflow are the money which comes to your pocket. Samples of cash inflow estimates are revenues, from sales and contracts, receipt of loan principal, receipts from stock and bond sales, operating cost reductions, which may result from an alternative, salvage value, construction and facility cost savings, income tax savings, cash outflows, or disbursements, may be comprised of the following, depending upon the nature of the activity and type of business. Again, in the simplest term, cash outflow are the money which goes away from your pocket. Some of the cash outflow estimates examples are operating costs, annual and incremental, first cost of assets, engineering design costs, income taxes, periodic maintenance and rebuild costs, loan interest and principal payments, major expected/unexpected upgrade costs. Next term in cash flow is net cash flow. As name suggests, net cash flow is the difference between the money which goes out and comes in. In other words, net cash flow equals receipts minus disbursements. Or cash inflows minus cash outflows. Net cash flow is important while doing economic analysis. One of the other points we must understand here is that, since cash flows normally take place at varying times within an interest period, a simplifying end-of-period assumption is made. Let us understand what is end-of-period convention. The end-of-period convention means that all cash flows are assumed to occur at the end of an interest period. When several receipts and disbursements occur within a given interest period, the net cash flow is assumed to occur at the end of the interest period. It is important to note that end of the period means end of interest period, not end of calendar year. Let us take a cash flow example to understand end-of-period convention. Figure on the slide shows a cash flow line for 5 years. Say, some cash outflow occurs on the first month of the year 1, and some cash inflow takes place at the end of 6 months. When we use end-of-the-year convention, the net cash flow shall be shown at the end of year 1. At the time of solving economic analysis problems, direction of the arrows on the cash flow diagram is important. A vertical arrow pointing up indicates a positive cash flow. Conversely, an arrow pointing down indicates a negative cash flow. Let us understand this with an example. Figure on slide illustrates a receipt, or cash inflow, at the end of year 1, and equal disbursements, or cash outflows, at the end of years 2 and 3. Let us take an example to understand what we have learned in cash flow and its conventions so far. A father wants to deposit an unknown lump sum amount into an investment opportunity 2 years from now, to cover his son's university fees. The amount should be large enough to withdraw $4,000 per year for 5 years, starting 3 years from now. If the rate of return is estimated to be 15.5% per year, construct the cash flow diagram. Let us draw cash flow for this problem. First part to solve this problem would be to draw cash flow line. As we read the problem, we find that the investment shall be done 2 years from now. This is investment, or money is going away. Therefore, as per the arrow convention we learned, this shall be represented by downwards arrow. This is first payment on the cash flow line. We shall represent this by P. The money is unknown, therefore we shall put a question mark here. Let us go to the next part. The father wants to withdraw $4,000 for 5 years from 3rd year onwards. As he is receiving money here, therefore, it shall be shown by upwards arrow. Let us show that now. As we know that this is an equal annual payment, therefore, we shall denote this by A equal to $4,000. Rate of return is 15.5%. Let us write as well. In business scenarios, investment and returns does not generally occur at the same point of time. Say for example, you are a cost manager working for an airport operator, and you have been asked to determine the feasibility of an airport project, which your company is planning to construct. Needless to say, if your company chooses to construct the airport, the investment shall be made in time span of next 2 to 3 years. However, the returns shall continue till the life span of the airport, which may last for several decades. We know that cash receipts in future cannot be algebraically summed, as the time value of money in future and presents are different. This leads us to the concept of economic equivalence. In this example, if we want to compare investment to the returns of the airport, we need to convert investment and return on same time on the cash flow line. Let us understand the concept of economic equivalence. Economic equivalence refers to the fact that cash flow, whether a single payment or a series of payments, can be converted to an equivalence cash flow at any point in time. Economic equivalence exists between cash flows that have the same economic effect and could therefore be traded for one another in the financial marketplace. Two sum of money at two different points of time can be made economically equivalent if we consider an interest rate and number of time period between two sums. The important fact to remember about the present value of future cash flows is that the present sum is equivalent in value to the future cash flows. It is equivalent because if you had the present value today, you could transform it into the future cash flows simply by investing it at the interest rate, also referred to as the discount rate. Discount factors. A moment before we talked about the concept of economic equivalence. We understood that cash flow, whether a single payment or a series of payments, can be converted to an equivalent cash flow at any point in time. Now the question arises how we can convert the cash flow to some other point in time. This is where discount factors come in. Let us discuss discount factors now. If you are new to the concept of time value of money, you may find discount factors a bit tricky. We would suggest that you first understand the discount factors. Later we have provided tutorials to gain understanding on each discount factors. Table now shown on the slides shows 7 discount factors, from single payment to arithmetic, gradient uniform series. There are 3 other columns in the table, namely, converts, notation and formula. In the upcoming slides we will discuss each factor in detail. We shall also understand what we mean by converts, notation and formulas of each factor. Single payment compound amount factor is the first factor we shall discuss. This factor converts present value to future value. In other words, it helps us find f when p is given. The notation is f by p, I, n. Formula is 1 plus I to the power n. Figure now shown on the slide represent cash flow for single payment compound amount factor. The cash flow shows that we have to find f when p is given. Let us discuss single payment present worth factor. This factor converts future value to present value. In other words, it helps us find p when f is given. The notation is p by f, I, n. Formula is 1 plus I to the power minus n. Figure now shown on the slide represent cash flow for single payment present worth factor. The cash flow shows that we have to find p when f is given. The third factor is sinking fund factor. This factor converts future value to annuity or equivalent uniform annual worth. In other words, it helps us find A when F is given. The notation is A by F, I, N. Formula is I divided by 1 plus I to the power n, minus 1. Figure now shown on the slide represent cash flow for sinking fund factor. The cash flow shows that we have to find A when F is given. Let us review the cash flow diagram critically. It is important to understand that, in sinking fund factor, cash flow for annual payment starts from the end of first period, and continues till the end of last, or nth period. Please note that any discount factor is specific to its given cash flow only. If in any problem that we shall take in the latter part of the course, have cash flow different from the cash flow specific to the factor, we need to adjust the given problem cash flow same to the specific factor cash flow, to use the discount factor. If you're finding it difficult to understand at this time, just keep a note of it, and you shall understand this better as we shall progress. The fourth factor is capital recovery factor. This factor converts present value or P to annuity or equivalent uniform annual worth. In other words, it helps us find A when P is given. The notation is A by P, I, N. Formula is I into 1 plus I to the power n, divided by 1 plus I to the power n, minus 1. Figure now shown on the slide represents cash flow for capital recovery factor. The cash flow shows that we have to find A when P is given. Please critically review the cash flow. As discussed earlier, note that any discount factor is specific to its given cash flow only. Let us review uniform series compound amount factor. This factor converts annuity or equivalent uniform annual worth to future value. In other words, it helps us find F when A is given. The notation is F by A, I, N. Formula is 1 plus I to the power n, minus 1, divided by I. Figure now shown on the slide shows cash flow for uniform series compound amount factor. The cash flow shows that we have to find F when A is given. Please critically review the cash flow. As discussed earlier, note that any discount factor is specific to its given cash flow only. Let us review uniform series present worth factor. This factor converts annuity or equivalent uniform annual worth to present value. In other words, it helps us find P when A is given. The notation is P by A, I, N. Formula is 1 plus I to the power n minus 1, divided by I, into 1 plus I, to the power n. Figure now shown on the slide shows cash flow for uniform series present worth factor. The cash flow shows that we have to find P when A is given. Let us review arithmetic gradient uniform series. If you're wondering what is arithmetic gradient, we shall understand in next few seconds. Arithmetic gradient uniform series factor converts arithmetic gradient to annuity or equivalent uniform annual worth. In other words, it helps us find A when G is given. The notation is A by G, I, N. Formula is 1 divided by I, minus, n divided by 1 plus I to the power n, minus 1. Figure now shown on the slide shows cash flow for arithmetic gradient uniform series. The cash flow shows that we have to find A when G is given. Now let us understand what is arithmetic gradient. A committee gradient is scenario when the cash flow increases arithmetically as the number of compounding period increases. Let's take an example to understand this. Say, you are a startup company which manufactures concrete form work. You expect that your sales for the end of first year shall be $1 million, second year it shall be $2 million, third year it shall be $3 million, and so on. In other words, there shall be an increase arithmetically with an increment of $1 million per year. This is an example of arithmetic gradient. Now let's critically review the cash flow of arithmetic gradient uniform series. Note that G for the end of year 1 is 0 and for nth year it is n-1g. As discussed earlier, note that any discount factor is specific to its given cash flow only, and, at the time of solving the problem we must look into this carefully. Arithmetic gradient present worth factor is the last factor we shall discuss. This factor converts arithmetic gradient to present worth. In other words, it helps us find P when G is given. The notation is P by G, I, n. Formula is 1 plus I to the power n, minus 1 divided by I square, multiplied by 1 plus I to the power n, minus n, divided by I into 1 plus I to the power n. Figure now shown on the slide shows cash flow for arithmetic gradient present worth factor. The cash flow shows that we have to find P when G is given. With this we complete our discussion on discount factor. In the next slide we shall learn how to read interest tables. Now we are at the completion stage of this lecture. In last few slides we learned about discount factors and referred to discount factors formulas. Interest tables are nothing but pre-calculated discount factors values presented in a systematic manner. Let us quickly learn how to use interest tables. Table now shown on the slide shows interest table for 5%. You can also download the interest table form download section. Before we begin, let me highlight that the layout of the interest table may vary based on the publisher, however the info shall generally remain same. Let us understand and learn how to read interest table. First thing is rate of interest. For example, the table shown on the slide is of 5%. Similarly, there shall be other interest rates tables on other pages. Second thing is discount factors. These factors are categorized in 3 categories of single payment, uniform payment series and arithmetic gradient. We have 8 types of discount factor, starting from single payment compound amount factor to gradient present worth factor. Text now highlighted on the slide shows how to use discount factors. For example, if you want to find future value when present value is given, we shall use compound amount factor, and so on. Area now shown on the slide shows number of discounting periods or n. Let us take a small example to learn how to use interest table. Suppose you want to find annuity when future value is given. Here we shall use sinking fund factor. Say, we want to find sinking fund factor for 5% interest rate, and for 6 compounding periods. This shall be denoted by A by F, 5%, 6. Let us search the value of this factor from the interest table. So, we shall go to the column of sinking fund factor and row of 6 compounding period, or where n is equal to 6. Therefore, the value shall be 0.1470. There's one important thing to note about use of interest table when it comes to CCP certification exam. Note that in the certification exam you will be given the formula sheet instead of interest tables. Therefore, as far as the exam preparation goes, you need some practice on calculating the discount factor by putting the values in the discount factor formulas. It was a quite comprehensive and exhaustive lecture, isn't it, especially for those who were new to concept of time value of money and various terminologies that we discussed in this lecture. Now, before we conclude this lecture, let us quickly review what we have learned in this lecture. We started this lecture with John's lottery award story. We noted that John's decision to collect lottery award immediately will fetch him more money due to the fact that $1 today is worth more than $1 tomorrow. Thereafter we understood following time value of money terminologies: interest, simple and compound, nominal, and effective; present value, future value, and annual worth. We understood the concept of cash flow and its conventions. We briefly understood the concept of economic equivalence as well. At the latter part of the lecture we discussed about discounting factors and their respective cash flows and use of interest tables. With this we complete our lecture on time value of money concepts. In the next lecture we'll talk about new concept related to CCP certification.